So we were just looking at, well, if the liquidity incentive program would be released, what are the metrics? What is the TVL relative to market cap? Would that increase? Would it increase the on-chain activity? Would it increase the TVL? And the answer was always yes, it does. If you reward people, if you reward protocols, activity comes.
Welcome back to Everything EOS, the longest running EOS podcast. I'm here today with Denis Carriere, the CTO of EOS Nation. He's a founding member of EOS Nation since the Genesis block. Formerly a geospatial engineer and with the Canadian Armed Forces, open source advocate, DeFi expert, smart contract developer for a different EOS reward system that includes Pomelo Season 2, which has distributed over $1.2 million in public goods funding, built Proxy for Nation with over 10 million EOS staked to it with their proxy. And also Joe Louis, EOS OG, super knowledgeable if you're in the EOS community, strong background in regulatory compliance. But what is your background, Joe? This is probably the first public appearance. I think you're definitely making on Everything EOS, but I think this might be your first interview that I'm aware of.
Yeah, I think a lot of people confuse the desire to have some anonymity is something's not right, something's off or sketchy or under the radar about this individual. When I feel like I'm maybe not the odd one out in this area. I think that anyone in the crypto landscape probably would embrace at least a little pseudo anonymity, but I've latched onto Joe Louis and that's who I am.
It's your reputation, though. You have an identity. Your identity is Joe Louis. Everyone knows who you are. And over the years, everyone knows you carry a very strong opinion. When the Yield Plus working group was formed, I think you were the only person that wasn't involved with an actual DeFi project or a block producer or some other entity within the ecosystem. You came in as this kind of mercenary because you have this special skill set. You're one of the most knowledgeable people in the regulatory and compliance aspect of all of the blockchain space, but most definitely DeFi. I could recall over the years when people were keeping tabs on different things happening in Congress or the Senate or different lobbyist groups. You were one of the only people that were ever tapped in and sharing information from these obscure databases that no one else would even know where to search. So is that something you learned as part of your career? Is that more or less something that's just been a hobby of yours?
So no, I think it probably more or less comes down to control. And when you start getting involved in this landscape and you start holding some of these different assets, Bitcoin and all the way back, I got into the ecosystem, the crypto or blockchain ecosystem back in 2012. And at that point, I don't remember exactly what pulled me in. It was probably some random blog post somewhere, but then I ended up spending just all my time in the Bitcoin talk forums and reading and researching and finally dive in through Bitcoin and Litecoin back then. And at some point, I thought, okay, these are fun hobbies and I'm interested in this. And I believe there's something here, but value-wise, you can't make a living off of it yet at that point. And so I was pursuing a doctorate in medical field at that time. And during the daytime in class, I was trading all the time. I had my laptop open, but I've got Bitcoin Wisdom up, watching charts because TradingView didn't have these kinds of fancy charts available for the crypto ecosystem at the time. So I've got Bitcoin Wisdom up. I'm running all these charts on one side of my screen. I've got some Word document from the professor on the right side of my screen and maybe a game in the background or something. But it's just watching my trades became predominantly what I was up to during my graduate program. And then after graduating, now I have to use this degree. I have to go into the medical field. But all the while I'm in these trading chats and I ended up connecting with an exchange operator that said they're always looking for good people. And I thought, gosh, you know what? I could rework this crazy resume that has nothing to do with crypto into something to do with crypto. And I think I just really had a knack for writing passionately about Bitcoin and Litecoin and what the philosophy of it all was and hope for the future. And so that ended up working after a series of interviews. And instead of going into medical after graduation, my first job out of graduate school was working at a crypto exchange. So it was a skeleton crew. You made up your own position, but everyone has to do just about everything. You're on call 24/7. I used to lay down next to my fiance at the time with an earbud in my right ear at night. And I'd try to sleep at night like that. And then an alarm would go off or a ping from Slack, and I'd check it. I'd just obsessively check and monitor and keep an eye on things. At that point, you had to learn just about everything. And exchanges in 2016 and 17, the bull run's coming on, the great bull run that ended in calamity at the end of 2017. And so exchanges that were doing 6 figures in volume a day, 7 figures. The exchange I was at all of a sudden went from millions in volume a day to billions per day in volume. It was coming and coming. And then all of a sudden, Bitcoin broke these previous all-time highs, and exchange volume across the board is what a lot of those exchanges are now considered your tier 1 exchanges. They survived that bull run back then, and they've been cemented into their positions now. But that experience brought all the policy, all the regulators, all the politicians and the lawyers and the traders' attention to this thing that was moving so fast, but nobody had any rules about it really. Regulations that were applying to exchanges at the time were really just expert advice, expert opinions, securities lawyers trying to give their opinions at the time, but nothing was really established in the regulatory landscape for how to treat these assets. And so here we are now in 2022, and you're seeing it's almost a daily occurrence. There's some news about regulations changing or bills passing. Just this morning, you saw how New York effectively they're trying to ban mining of proof of work coins. It still has to go past the governor's desk, but that kind of thing became super important to me years ago because being involved in crypto became viable to me as a full-time job, essentially, independently. I didn't work at the exchange anymore. I left the exchange and I've been for years now, just myself and in crypto exclusively. But at that point, if you're going to do that, you need to become your own expert witness as far as taxation and policies and regulations so that you can look down the road a little bit about what's happening, what's approaching. Because at some point, you do have to realize there are a lot of people that are just playing, trading a little bit here and there. They're hoping something moons. But someone in my position, kind of staked my family on it because I went this independent path of being full-time in crypto and not being connected with an organization or working for anyone. That's why I've made policy and regulatory work essentially my full-time job now, is so that I can selfishly keep up to date on it from my own dealing, but it just happens to be valuable for something like this.
I think, and I've thought this for years, but the EOS ecosystem has been much better off because of you. You said a key word while telling your story, and that's passion. And with all of the working groups that the ENF has established, I think passionate people and passion for whatever the given subject of that particular working group, what their mission was. So whether it be wallets, audits like for security, core protocol, and in this case, Yield Plus, the group was formed with the most passionate and knowledgeable experts within the ENF with a specific mandate of coming up with a proposal and research and competitive analysis about how could we increase TVL and DeFi activity on EOS. So let's go back to how the Yield Plus group got started. Denny, do you remember exactly how it came to fruition?
Yeah, so it's a little blurry, but let's say I would think the wheels were starting to run when Block One proposed their staking pool. So Dan and Block One, they proposed sort of a six pools with different time intervals. It took a little while to get that paper out, so they delivered a paper explaining that, but it never really came to light, that implementation. So after that hype of after we were expecting some sort of staking pool or some sort of yield return on the system level contract, it never came to light. It never got implemented. So after that, there was a sort of a void, of a yield void of people wanting to earn yield on EOS, but no mechanisms to do it. I guess most of us that are in the DeFi space were talking about what should we do? There's all sorts of different protocols out there. Do we build a protocol at the system level? Do you build a stable token? Do you build any types of DeFi protocol? And it just got us thinking about how to go and build something at the system level, or at least a reward system contract. And then that's when sort of ENF said, oh, we should spin up another working group. a Yield Plus working group. And then we're like, who else would want to participate with this? So then we started getting different DeFi protocols. So Defibox was called to ask if they want to participate. Pizza with their pizza lending. The Origin team, so the EOS Titan, they've also joined on the technical. They have a lot of team members that have PhDs in mathematics. So they joined for the economics side of things. And we end up forming that Yield Plus group. And within an hour of them saying, hey, do you want to participate in the Yield Plus? They like called me and then they said, all right, let's jump in, let's go. And essentially started talking about how are we going to tackle this? Because we didn't really know what the direction would be. We just knew we needed to get some yield mechanism at the system level. How we got there, that was the journey of formulating the Yield Plus group.
I mean, I remember the first couple of weeks, the group wasn't official, but we would meet, I think, every Monday morning. And after about 3 weeks, I think everyone had a pretty good idea of what the requirements would be, and everyone bought into it because it was a huge effort to compile all of this research and written work, collectively thousands of hours. And even now, the work hasn't really stopped since the paper came out, because what's proposed in the paper is some Oracle smart contracts, a front-end portal. And all of that development that was proposed actually began before the paper was published. And that was just because a lot of the things with EOS were playing catch up. We need to move really fast. So a lot of the liquidity programs to maximize TVL on the other chains, as part of this blue paper, as part of the research, all of those other layer ones were analyzed. And I believe Origin were the leaders of that particular section, where it would look at, okay, when Phantom turned on their TVL program last early fall or late summer, what happened to their market cap? What happened to their daily transactions? What happened to their daily active users from the time that this program started? And it was very data driven. And all of the charts are in the blue paper. It looked at Matic, looked at Solana. And that was the idea, is how could we imitate what they did and do it in the best way possible, because we could take one thing from here, one thing from there, put our own flavor on it with the power of EOSIO and the flexibility that we have. And what could we come up with collectively with all of the best minds in the space?
For me, I was brought on more specifically to talk about regulations, if there's any tax implications, or just provide some idea to the reader what goes into a program like this beyond just issuing a reward to qualifying participants. And one of the big components of this program is designing a treasury that everything feeds off of. And that treasury really has a lot of implications put on it by the global regulatory policy. And that's rapidly evolving around the world. So it's important to have a perspective, I think, on that by reading the paper and understanding this program, rather than just, here's a program, it's going to reward qualifying dApps and we're going to grow TVL. And I think there's a rationale for having some perspective on, well, what are the implications of doing something like this? Is there a different way we should do it? Are there some other considerations when we build this thing? Or do we just code it up and send it out there and let the cards fall where they may? So the treasury section was my contribution. And then I think Denny and Miles and myself co-edited the paper front to back after that.
Yeah. So part of the reason we're recording this is, one, I don't expect everyone in the community to sit down and read a 70-page research document. So there's been a lot of questions in the Telegram groups and on Discord of one thing like the TLDR version. It's really hard to summarize everything into a few sentences, but you said it there, Joe, and we said it throughout this conversation. It was an initiative to increase DeFi, TVL activity on chain, and create a rewards mechanism that could reward people for locking up tokens or putting tokens to work in DeFi and liquidity pools or in lending, and just really increase that on-chain activity. And it plays into a lot of the things that people want to see in the community. There's often people who talk about, like with centralized exchanges, for example, how do we get tokens off of those exchanges? Well, you give them something to do on-chain. And that's what I envision that this program, once it's put into action when the portal and smart contracts are live, is it's going to create multiple opportunities to generate yield at all different risk levels also. And going back to the origin story that Denny was talking about, initially it started with the staking pools proposed by the PBE in block 1. And what they were proposing was something base layer. It was one option, kind of vanilla. Whereas with Yield Plus, because it's an actual program that multiple DeFi protocols can take part in, it creates a very robust system where it gives multiple options. Instead of just staking into Rex and collecting a direct drip of yield, you could actually put your EOS to work in many different ways, and even in some ways we can't even probably think of today. So Denny, since you also are familiar with all of the other protocols and what they've done and what led up to this, how would you describe what Yield Plus is proposing compared to what's been proposed on the other layer ones that were compared throughout this process?
The comparison, like a lot of the other layer ones have successfully done successful TVL liquidity incentives. And that's why some of our research is actually based on those success stories, right? If you announce a TVL reward system, like a liquidity incentive systems, and the economic activity increases and market cap increases and price increases and everything increases, then every single layer one should be providing liquidity programs. So we were just looking at, well, if the liquidity incentive program would be released, what are the metrics? What is the TVL relative to market cap? Would that increase? Would it increase the on-chain activity? Would it increase the TVL? And the answer was always yes, it does. If you reward people, if you reward protocols, activity comes, right? If there is no economic incentives to deploy a protocol on a particular chain, it's very difficult for those protocols to pick that chain to deploy their heart and their energy, their time, their developers, and on top of it, the liquidity that will flow into that protocol. So if each of these layer ones have these incentives, these liquidity incentives, it does attract developers. It's a fact. If you have financial, economic means to attract developers and protocols, they will build on those chains up to a certain amount. Eventually, you hit a cap, and that's where a lot of chains on those layer ones that have these programs for a year or year and a half, they've hit that cap. Now they're like, all right, now we've got all the attention. Now we have to sustain this. And that's the hard part. That's like the next stage where EOS has never really hit that stage of too much activity, which is BSC's problem, or this, when you have too much activity, eventually the chain kind of boggles down and then you've got other problems that you have to solve.
And that's something that you mentioned BSC, Avalanche, even Matic when it was going through its DeFi peak. Like, even though they're obviously cheaper than like Ethereum as far as layer ones, their fees still went 50 cents up to $2 per transaction, which seems cheap because if you're comparing it to like ETH DeFi, but there's still a lot of limitations with that when you're talking like infrastructure you could build. Like with EOS, you could have oracles, and these oracles already exist. They're updating every half second or every few seconds. Price feeds, you could do high frequency trading. There's all of these things that are possible in EOS that are not really possible on these other chains when they're at peak usage, and that's when their fees could go up. But we've seen in the past, like EOS can go up to over 100 million transactions per day. And with the new resource model, which was implemented after all of the IDOS things, like even at 100 million transactions per day, the fees would still really they'd be negligible compared to any other chain. So I'm excited to see what happens when the activity increases, but you don't hit the same congestion and fee issues that we've seen elsewhere. I think the other thing that's unique is that the Yield Plus working group itself, part of the application process, part of the approval process, and then for the fund distributions with the ENF, it's like a coordination effort. Our coordination was we brought together all of the smartest people. We gave them funding to develop the ideas and put pen to paper to really explain the thought process behind this liquidity program. When you look at Phantom or Matic or Avalanche or any other chain that's already been successful with these liquidity incentive programs, they typically narrow it down to a 1 or 2 page blog post that's the end results of probably months of thinking and discussion on their end. But their communities never get that insight into the whys behind it all. And I think that's something different here also, is we can away took a page out of the Cardano book and did some academic research before jumping into anything. And because of just the level of kind of openness and transparency within these groups, we presented all of the data, and that's what came out with Blue Paper. And everything's structured in a way because of how Joe suggested with the treasury management and how the multi-sigs are going to work. It's doing it in as future-proof of a way as possible to stay regulatory friendly over the long term, rather than with a lot of the other programs, the foundation's a kingmaker and decides who's approved for the liquidity program. It's their own decision, how much each gets. Whereas with this, what's proposed is the time-weighted price oracle, and then that's what decides the distributions. The approval process is a multi-sig of many different parties, and a lot of it's smart contract driven. And correct me if I'm wrong, but not all of the other incentive programs on the other chain are even smart contract driven.
Yeah, that's correct. So the big thing is having everything on chain. Everything's provable with a smart contract doing those calculations, those TVL Oracle data points. Some other chains that have these reward systems, what they would do is they would use DeFi aggregators that are off chain. However, those DeFi aggregators are still quite accurate and they would still have some good reporting, but it would still be off-chain data points, which could be manipulated. Different assets can be maybe added to the TVL, so they would boost the TVL reporting based on a code issue or a plugin or an adapter issue. I'm not too sure exactly how they solve reporting that is like inaccurate. They might have different but they don't explain it. So they have this one page, and all the edge cases that we had to think about. What happens if this happened? We had many months to think about it, write it down. And then once you write down all these edge cases, you might have to think about, I'm going to solve it by this. And then you got to explain what this is. So I think having to think about the overall mechanics and also making sure that the Yield Plus paper empowers DeFi protocols. So we're really trying to empower DeFi protocols to build on chain. So how we do that, trying to make it as limitless as possible. So as much diverse different amounts of protocols that can deploy on chain. What the goal is that we don't want one product. We don't want one lending protocol, one swap pool. We actually want a lot of competition and a lot of the community members building various different protocols and competing against each other, because as you build a lot of DeFi protocols, those synergize with each other. So if you have 2 or 3 or 4 different swap pools, they can actually trade among each other, which increases value, it increases the swap fees, it increases their trading volume. So having multiple different protocols available on EOS, all being incentivized, you can do lending arbitrage. You can borrow here and deposit there. But if you have one lending protocol, you don't have choices anymore, right? You just have to deposit there, and that's the only place. So I think having a diverse, wide distribution of different DeFi protocols will be very healthy for EOS. So all of these protocols need to have some sort of baseline minimum TVL. And there's also going to be a maximum. So we don't want one protocol to take 80% of the rewards. We want 5% here, 5% there, 3%, 2%, and small amounts of rewards. That way it's a little bit more distributed in terms of the types of protocols, in terms of the teams. You're going to have some teams that might have more than one protocol because they might have the team capacity to build 1 or 2. Maybe they build a lending protocol and a swap pool. But maybe another team might only have the capacity to build only a swap pool or a vault or some basic level of staking pools or whatever types of protocols. But it's essentially limitless in terms of what you can build, and you can apply for Yield Plus. So as long as you have a functional website, functional smart contract, if you have an audit, that's a positive, because if you are expecting depositors and community members to deposit assets into your protocol, it would be a good idea to have an audit and make sure that the funds are safe. Also, you could register with Recover Plus in case there is an issue. Then you have a dedicated team to help you with the recovery process, if it's even possible to recover funds in case of a loss. So I think it's really good to have as much different types of DeFi protocols join the system.
I think with Recover Plus as an insurance policy, but also, as you mentioned, creating a robust ecosystem rather than some one lending protocol that just does all of the lending, it limits systematic risk also, because you really don't know something could be exploited until it is. And if it happens fast enough, there's no guarantee Recover Plus could even do anything. But by having caps on each protocol and what they could earn, like the level of TVL they can get to before their rewards just get too diluted, limits the risk possible if one of those projects or products fail in some way. What is the process for a project? So what's the TVL minimums? What's the TVL maximums? And what's the application process going to look like?
Right now, it's all configurable. There would be a minimum of 200,000 EOS in terms of TVL requirements. But that could also be a mix. So you can have Tether and EOS. As long as your EOS equivalent is above 200,000, that would be the minimum bar. And up to 6 million EOS in terms of EOS TVL. Again, it could be mixed between Tether and EOS. Those would be the TVL requirements to fit within the system. If you have above 6 million EOS, that's fine too. You're just going to get capped. Your rewards are going to stop at the 6 million mark up until if ever Yield Plus increases those thresholds. So initially, Yield Plus will have a limited amount of EOS to redistribute to the network. So we can't have a system that allows 100 million EOS per protocol because there's only so many rewards to distribute. In terms of the application process, there's going to be a portal. So there's going to be a UI, like a website that users will be able to join in. They're going to be able to put their name, their protocol type, their website, audit. If they have a CoinGecko listing, so if you're listed on CoinGecko, or if you're listed on CoinMarketCap, all of the sort of DeFi analytics, you can be able to put in, register. That way we can have an aggregate of all the different protocols. We can make a lot of nice sort of analytics with that metadata from each protocol. And also by providing more information to the portal, you're also giving depositors more information of, oh, this project is listed here. This project has an audit. This project has a Discord. Maybe I can go and log in and I can go and talk to the team. So this will act more of a discovery portal as well, that projects will be able to list their information for their projects. Once it's submitted, then there's going to be a review process with the Yield Plus auditing team, making sure that the smart contract is in fact a DeFi project, making sure the website is live and functional, making sure that all the credentials kind of line up and make sure that it's not a fake project trying to apply for Yield Plus. And also if there's any issues, the team can go give feedback to the protocol saying, you should fix this. This link is broken. It's going to a dead link, stuff like that. Once there is approved, what happens is there's going to be oracles that will then calculate the TVL per that project. That project will submit the smart contracts and treasury accounts that are related to their project. So if you're a DeFi swap pool, you'll have a smart contract with your assets. You're going to register that with Yield Plus. Then the Oracle system from Yield Plus will collect data points every 10 minutes of your balances. Those balances will be computed. And at the end of the 24-hour period, you can then start claiming rewards as long as you meet the minimum and the maximum threshold of the TVL. After the 24-hour period, you'll be able to claim every 10 minutes. So if you've got a DeFi application that you want to reward your users at a higher frequency, you'll be able to claim every 10 minutes your rewards. Or if you want to only claim your rewards every day, you can claim every day. If ever you go below the minimum, your rewards will stop until you go back to that average. And that's
and the oracles on chain also do the USD calculations, because one thing that I like is that everything's measured in EOS. So that means if the price of EOS does go up, then actually the liquidity requirements go up also. So if it's like a USD EOS pool and the price of EOS goes up, there will be more USD in the pool to meet the same 200K EOS threshold, for example.
Correct. You'll have to be incentivizing a mix of assets. That's why I think a lot of protocols will have Tether and EOS. Let's say if you hold 200,000 EOS in actual spot EOS, then you don't have to worry about hitting that minimum requirement. If you hold 200,000 tether worth of EOS and EOS goes up, then you might go below that threshold and you'll have to, attract more tether to your protocol. But if EOS goes up, then you should technically also attract more tether if the price going up. Usually the assets go up as well. Yeah, and everything's gonna be on chain. So all of the interactions with the oracles, it's all computed on chain and it's all automated. So there's no false reportings. It would be a smart contract to smart contract. So the Yield plus smart contract will communicate directly with the contracts that you have listed. Say if a protocol claims they have $1 million worth of TVL, but in their wallet that they have registered, there's not $1 million. The oracles will look at that wallet and say, in this particular wallet, you don't have $1 million. You have half of that. It's also an auditing process as well for auditing the DeFi protocol's contracts, making sure that they are reporting exactly what they're saying. The other one too, this is just for an edge case for a lot of the lending protocols, is a lot of lending protocols, depending on how they count their TVL, it's deposits minus your borrowed assets. Because sometimes you'll have a lot of deposits, and if you only count the deposits as your TVL, but not your outgoing, you could deposit, borrow, redeposit, borrow,
wind it up,
and then wind it up. And then you essentially get an inflated TVL of only deposits. But in fact, it's the same deposit just circling into itself. So if you're auditing, the oracles will only look at the balance, not what the DeFi protocol says that they have in deposits. So it looks at the current balance, which would prevent all of the double counting.
The other mechanism that avoids double counting is in the initial phases of Yield Plus, the only assets that are being calculated are the two hardest assets on the EOS protocol, and that's EOS itself and native US Tether. And part of that was because once you start creating derivatives of stable coins or derivatives of staked EOS somewhere else, you could just start layering up. But in later phases, so in phase one, it's just EOS and USDT, and it's just on native EOS for that phase. But then phase two, which shouldn't, in my mind, as long as phase one's successful, phase two might not be too far behind. That would extend to the EVM, and it would also potentially add other, let's say, bridged assets. So maybe like bridged USDC or bridged Ethereum or things like that. What's the current status? So the blue paper was only published 2 weeks ago, but like I said, the development actually started prior to that. So what's the week to week looking like as far as like the group's still meeting or what's going on? And what's the expected delivery date? When do you anticipate that all of these things that we've been talking about today, when do you anticipate that it'll be actionable and people will start being able to stake their EOS and Tether for yield?
So what has been done is we've mocked up a UX and UI design. So wireframe of the application, wireframes of logos, wireframes of pages, wireframes of how to expect the protocol lists and the analytics and how people are going to be submitting their DeFi protocol submissions. The front-end development is in progress, so that's just started. The smart contract development, we've just finished the prototyping. So the initial smart contract for both the reward system and the Oracle system. So that's been developed. We're still in the development phase of the smart contract. It was demoed last week. And the next phases for the smart contract is the auditing phase, which will be most likely, I think, at the end of the month, I believe. So maybe the third or fourth week. The development will still continue. So usually when you get an audit, you get a lot of feedback. And then it's still another 2 more weeks of development to fix the things that the audit found. And then there's a re-auditing process again after the development to make sure that those things that were found in the audit are covered. In a month or 2, we should have a really good progress of the full development suite. That's the front end, the back end, historical data points. So a lot of the portal will present the historical TVL of each application. So there's going to be some back-end requirements to display all of the historical information about all of these apps. That way you can see, okay, a month ago, this app had this much TVL, and this week it had this much. So yeah, I think that's where we're at in the current development phase. I don't have a date or a month or a timing on when this would be executed, but it's moving at a pretty good pace. 3 teams working on this actively. The smart contract development front end and the back end. So that's the EOS Nation, Origin, and Defibox. We meet twice a week. So we have a meeting call, like a planning call, and then a development call.
Let's talk about what to expect in the next few months when this is actually live. Once you unlock the TVL incentives, the liquidity incentives, what kind of applications are possible, or what kind of use cases within the applications that either already exist or don't exist yet? What are some of the things that'll be possible on chain that you can't really do today because the incentive structures just don't align?
Yeah, a lot of DeFi protocols will be able to apply once they hit the minimum requirement. The next part is a lot of DeFi protocols need to make a token to incentivize attracting liquidity. What's good with Yield Plus is at least that gives that baseline, at least it gives those protocols at least a minimum amount that they don't have to sacrifice so much their own token, their own governance token. They can be a little bit more conservative. They can say, instead of trying to make a token and then just give it away to get to $1 million, let's get to a higher amount. Let's use the Yield Plus rewards and then launch a token. So you can give rewards with only Yield Plus without even releasing a token. So some protocols could get to a point without even releasing any tokens themselves, wait a few months, but because they have a protocol with liquidity, at least their depositors are not going to be stuck without any rewards for 2 or 3 months while the team figures out the sort of tokenomics and the governance aspect of that project. A lot of projects have a hard time attracting liquidity because they don't have strong incentives to keep that liquidity in their protocol. Yield Plus, as long as they meet the minimum threshold, they will be guaranteed that 5% APY. And that way it should be enough to keep that project going with enough incentives until they get to the next stage of the development process.
I mean, I was just in public Eden group the other day, so I gave them an example. Not every project needs their own token. Why doesn't Eden create a simple locking mechanism? I gave the example of 30-day lockup. You stake your EOS into a vault and you lock it for 30 days. And as long as there's 200K in this vault, they would qualify to submit and be approved by the Yield Plus working group. And then all of this Eden members could be incentive, or even non-members. So I've seen Chris Barnes mention he wants to do some DeFi strategy where you get a bonus if you're an Eden member. And you said, Chris, you can't force Defibox to reward Eden members. It's just not going to work. But if Eden built their own vault, then of course they could incentivize Eden members over everyone else. That doesn't stop other people from using the vault, but you're favored if you have a verified Eden account. And it could be very simple things like a token lockup, and then you could build things on top of that. But then on the other side, what I'm excited about is projects that do have their own tokens, whether it's a brand new token or an existing project like Defibox or Pizza or whatever project is. Just because the protocol is getting an EOS reward doesn't mean that they have to directly pass that EOS reward to their end users. If you're an LP on Defibox, they could use that EOS to do a buyback. They could use that EOS to automatically stake it into their own liquidity pools to deepen liquidity. They could use it as a backstop for their lending protocol. They could do so many things with it to drive different levers of the system to do different things. I think it'd be cool to see buyback and burn mechanisms, because I could reward you with my token or I could reward you with EOS. But if I reward you with my token and at the same time I'm staking the EOS, matching it with my token and deepening the protocol and liquidity, then even if every single user that's received that equivalent to my own token, so I'm giving you 10 EOS worth of Zack tokens instead of giving you just the 10 EOS directly, if you sold all of the Zack tokens, you'd still end up getting 10 EOS, kind of like a monetary expansion exercise. The other thing I'm excited about is kind of like negative interest rates or offsets. So with lending protocols. So for example, if I want to borrow a stable coin on Pizza right now, I could borrow USDT from Pizza for 8% at the current market rate. But if you want to be safe, you want to have at least 200% collateral. So if you have 200% EOS, it's like a 5% yield. You're actually getting on your collateral 10% more than what you're borrowing. So you're actually getting a negative interest rate. On Defibox, you can generate USN at a 1% annual rate currently. And if they're doing kickbacks on the rewards, it would also depend on the protocol, because they have the flexibility of, do they pass back 100% of the rewards? And then in what token do they pass it back? But I think for sure something's going to be rewarded, whether it's in their token or in EOS. So if I'm staking 100,000 EOS into Defibox lending, I'm generating 50,000 EOS worth of USN. I'm actually being paid to do that because my EOS is earning yield. I generated all of this USN, and I could sell half that USN for Tether right now and get a 25% yield on that. So you could do all of these different stackings of different protocols. That's just all within Defibox itself. But with the more protocols you have, you can stack across different protocols depending on what services they're offering. So I'm really excited for that, seeing like negative interest rates, because that's where you're incentivized to borrow. And when you're incentivized to borrow, then you create new money, and then you could put that new money to work in DeFi, and you just start building up the DeFi ecosystem. The liquidity pools get deeper. The deeper the liquidity pools are, as long as there's multiple ones of them, it creates arbitrage opportunities, which increases trade volume, which increases organic fee and revenues within the projects themselves. So that's what I'm really excited about. Once the EVM's launched, and it just becomes super easy to spin up a clone or some kind of Lego block mishmash of a DeFi protocol in there, you eliminate a lot of the upfront engineering costs that you may have building on native EOS, because there's not as many libraries, there's not as much open source code to piggyback off of. So if you want to build a brand new protocol in EOS, there's more overhead on native for getting off the ground with a brand new protocol. Whereas once the EVM's live, you could spin up a sushi swap clone. And as long as you're able to attract that 200 EOS worth of liquidity, you automatically have your reward. And then you strap on a brand new token with a very limited supply, like a fair distribution mechanism like YFI. You can create some really cool economics that could create a lot of excitement, because there will be all these new projects, limited supply, high yield rates, because usually with a new project, like anyone who's been in DeFi, anytime there's a new token on a new project, the yields are usually typically unsustainable, but they're quite high initially. And I'm looking for that, because that's like an exciting time. It attracts new users because they see those 3-digit yields, and everyone knows that it's temporary, but it attracts fresh blood into the ecosystem. Over the long term, these liquidity incentive programs are proven models. They work. The hard part is, how do you sustain it once it gets diluted and it's been around for a while? And that'll be the next phase of this. But I'm excited for the first phase of just drawing in new people, because I feel like I've been seeing a lot of the same people for the last couple of years, and the gang has gotten a little bit smaller over the years. And I'm just really excited to draw in that brand new community. And especially with the EVM, like there's just so much opportunity, and there's so many teams that have already been very successful in other chains that they could either have a multi-chain strategy, or someone could just spin off a fork very quickly and easily on the EVM. So that's what I'm excited about. How about you guys?
Yeah. Or Joe.
I was just thinking about these highlights. Trimbot brought that up yesterday in Telegram, and you touched on it there. And I was thinking the whole point of this program is to draw attention. Even though native EOS dApps can participate, and those that are here that are already here, that have been here forever, they can participate, sure. But it attracts the attention of outsiders, I think, is really key, especially with the EVM approaching. Outsiders then also have the ability to participate through that EVM, like you mentioned. But any enterprising individual that has created a dApp, whether they read about Block One years ago and they thought that's a scam, and then they turn their ears off to anything EOS related, and they just attributed it. Any enterprising individual that sees there's some kind of promotion, at some point, you would figure they would want to at least minimally investigate what's involved in achieving a little bit of a reward. And if it pans out that, oh, okay, this isn't that difficult, I do this already on these other chains, this is really already done this before, so I can just apply on this chain and start collecting these rewards. And even if their mentality going into it is to say, I'm just going to collect these rewards for a while and then bounce. I'm just here to drink from the tap while it's running. The idea in my mind is, if you genuinely believe this chain, the technology, the functionality of EOS is something remarkable, then that's the whole point, is to at least get them to take a peek over here. And if they bounce, fine, that's okay. Maybe they have found Shangri-La on some other, blockchain that offers something amazing. But an important thing is to get them to take a look at what the chain can do, and maybe have them reevaluate. You guys have both seen this in Esteban doing the trust swap. He had no clue about EOS. He just came over to take a peek at the EVM and he's, oh, wow, I've been working on EVMs with BSC and Avalanche, and his experience seemed quite positive. He's digging in deep into the EVM alone.
It's a big user acquisition strategy. Just the yield incentives themselves are user acquisition. It's a marketing strategy. And you're right. What we've seen with the trust swap and Esteban, what he's doing, I'd imagine as the EVM gets closer to launch, especially after it launches, you're going to see a lot more people coming in just like that. He's one developer and he's already built an entire swap, multiple smart contracts deployed, multiple token contracts deployed. It's all been relatively easy for him. There's thousands of other developers like that are just looking for opportunities. And it's just prior to the EVM and prior to having Yield Plus, especially, these opportunities just didn't present themselves in EOS.
Developers like Esteban, they definitely catch my attention because, like I mentioned, there wasn't a reward for him. He just saw that there's an EVM on testnet for EOS. Let's give this thing a try. And now he seems hooked based on reading his commentary. And now he's producing documentation and weekend educational, videos. I'm like, wow.
You're right. He didn't even know about Yield Plus. He was just building on it because he thought he messed around with it and he thought it was really fast and the tech was good.
So that makes me think that if there's a program, something that promotes people that aren't looking, that aren't like Esteban and they're searching out for tech, then they stumble across the Trust EVM, that if Yield Plus can grab that attention and then hook them in to come take a peek, maybe any dev that's Esteban's caliber would find the same merits.
Also on top of that, I guess, speaking EVM itself, so because of the economics and the gas governance token, the EVM token itself, that's an additional incentive layer on top of all of this. So you have Yield Plus. If you launch a DeFi protocol on the EVM and you can get a minimum of 200,000 EOS, like that's the minimum threshold for yield. And then we still don't know what the EVM team's going to decide to do, how their community treasury will be managed as far as like developer incentive programs or their own liquidity incentive programs. So if you're a new DeFi protocol or a new swap and you want to launch on the EVM, we already know about Yield Plus because the blue paper's out, it's being developed. But that doesn't stop the EVM itself from also using its own token as an incentive mechanism on top of all of that. And then on top of that, there's the native tokens themselves. If any of these lending protocols or swaps or vaults, if they have an additional token, then it's just like the incentives start compounding at that point. And I'm really looking forward to seeing what kind of projects show up, just because the ones I know about, the main one that's been public is obviously the trust swap, but I'd imagine that there will be dozens of new projects like that popping up, especially once the first initial one starts seeing success.
One of the things I want to talk about is the getting EOS tokens active on EOS. So a lot of tokens on EOS are not really on EOS. They're on Binance Exchange, OKX, Bitfinex. It's fine. They're just on exchanges. They're on chain, but they're in cold wallets or in hot wallets for exchanges. Exchanges serve a purpose. They provide that professional trading experience. But one of the big benefits with Yield Plus is getting that EOS active in the chain doing smart contract related DeFi. So I think that's one of the big things is getting EOS locked up in the chain, doing DeFi protocols. And just to give you a concept, for the first phase, there's going to be a request for about 650,000 EOS per quarter. And that would lock up 50 million EOS on chain. So about 50 million EOS will be locked up into Yield Plus if all of the projects and the protocols fill out the program. And in the next phase, when we ramp up into the accelerated stage, it can grow up to 2 million EOS per quarter. And that would lock up 200 million EOS, which is about 20% of the entire chain. So if we can get to 20% of the max supply of EOS locked into DeFi, I think that's a success. And if we can achieve that, then maybe we crank it up again. I don't know. The goal is essentially to max out Yield Plus, right? The goal is to max out the rewards that are going to be allocated per quarter, distribute that to as many different protocols as we can. So that way we are utilizing the rewards for Yield Plus and distributing it to different protocols. We really want to see as many protocols to join and apply. And hopefully we can max out each phase, the first phase on the launch phase, which will lock up about 50 million EOS. And then the accelerated stage, when we increase the rewards, it would allow 200 million EOS worth of value locked up on the chain. So I think that would be really beneficial.
So for comparison, I'm looking at Rex right now only has 53 million EOS in it currently. And that's the most locked up EOS anywhere on the chain right now.
A lot of those Rex are not in protocols. They're cold wallet that stakes a couple million. So there's a mix between exchange wallets in Rex, which is fine, right? Exchanges are allowed to stake into Rex. But out of that 50 million, I would actually be very curious to know how much EOS is actually in protocols that are live doing swaps, lending, stable token, collateral. So I think it's really to get active EOS on chain and not just dormant EOS,
What you just brought up is interesting because I don't know if you coined the term, but you coined it for me. It was wrapped staking. And a centralized exchange could always have better yields than what's available on the chain, because what they do is they keep some liquid. They're earning rewards from their hot and cold wallets usually. But then if they have a 90-day lockup and you get a 10% yield on your EOS, if you lock it for 90 days, where are they getting this 10% from? It's because there's a lot more tokens that are being staked and getting like a 2% or 1.5% yield because they're staked into Rex, but only like maybe 5 or 10% of the EOS on their platform is actually locking for those 90 days. So there's all of these rewards being paid to a small handful of people willing to lock their tokens within those exchanges. So that's possible with Rex, but with the Yield Plus program, like you said, all of the protocols will be spread out and exchanges have to be very risk averse as possible. And that's typically why you only see them doing native staking for yield. So I highly doubt you'll see like a Bitfinex or a Binance or a Huobi staking into like Defibox, for example. They're going to continue to stake into Rex, where the rewards are fine. That's with the voter rewards, it's give or take 1.5 to 2%. So it's something, but they're not going to have the same yield potential as the users who are moving their EOS on chain, using their own wallet and playing around on chain and DeFi. You're going to have better opportunities on chain than you're able to get off chain on a centralized exchange, most likely, because they can't do the wrapped staking. They technically could, but I don't think that they will because, like I said, very risk averse.
Yeah, for sure. And like I said, it's to make sure that the developers building on EOS have ways that they can access rewards for building those DeFi protocols, and also reward active participants that want to deposit onto chain and not go onto, let's say, an exchange. Exchanges will always offer yields on every layer one asset. That's just a part of their business model because they make money through trading and options and futures. They want as many products and services on their exchange. That's not going to take away their product. It's just going to complement it. It's going to
more options too. Like you could already get the yield on a lot of these centralized exchanges. It's still going to be there. It's not going away. If anything, it might go up. If less is staked in the Rex, for example, they could potentially get not much more, but a little bit more. But then you'll have all of these other options, dozens of different places you could park your EOS or USDT or eventually bridge tokens and things like that as it expands.
And also the goal is that on-chain would be the best place you can earn EOS. Because right now, EOS on-chain for staking is low yield compared to the exchange staking pools. So with this is actually, you can have a DeFi protocol also stake into Rex. So right now, the Yield protocol will go and read the Rex balances, or if you want your EOS to be staked in CPU or net, it will be able to read the balances in your staked balance as well.
Right now, you're using Defibox. As an end user, it feels like all of the tokens are liquid because if I buy EOS, I just get it. So it's obviously liquid. But underneath the surface, most of that EOS is actually staked.
Yeah, there's like a calculation of 80% staked and then 20%. And then if liquidity gets removed, it will start selling Rex.
So in that sense, Rex should actually increase.
Yeah, it will increase, I think. But that's why you can compound a lot of these sort of like earning, right? You have some earning on Rex. You have some earnings on voting proxy rewards. You have earnings of Yield Plus. You can start stacking these sort of compound APY, and then you can probably get to 8% without really doing that much. You've got 1% here, 2% there, 5% there. And then you can, on top of that, have your protocol earn fees from being the protocol that you're operating. So I would see that some projects could easily get to 11, 12% stable APY. They can definitely get into the double digits with just a standard solid DeFi protocol, whether it's lending or whatever protocol that they choose. And yeah, just keep stacking those yields. And maybe if it's on EVM, on Trust EVM, they're going to be a fourth and a fifth,
Yeah.
Who knows? Who knows how many compound APYs you can get, but that's the goal with these DeFi Lego blocks is you keep stacking. So we're just in the next Lego block for yield.
Awesome. So I usually try to keep these around an hour. People have short attention spans. I think we're a little bit over. Is there anything that we missed in this conversation that we weren't able to cover from either of you guys?
I think you touched briefly on it in the beginning. I think one of the paramount features for me, from my perspective, as somebody that was really interested in the policy and the regulations, is, believe it or not, there is quite a bit more transparency baked into this product than you would find in analogs on other chains. It's unfortunate that a common practice across a lot of these top market cap chains is underutilizing some of the key features that blockchain, or especially public blockchains, purport to champion. And the theory of decentralization versus decentralized in name only, when you start scratching the surface on a lot of these projects or and what's going on beneath the surface, it can be disappointing for somebody that wants that transparency. And I think every aspect of Yield Plus will be pretty obvious. And if there's something not obvious, I'm sure you'll be able to ask somebody and find the answers you're looking for. Especially if you find me on Telegram, I'd be happy to sort that out, especially.
Awesome. So I hope everyone watching this, they got a better understanding of what the goals of Yield Plus were, what's still under development, when to expect all of this come to fruition. And then once it does come to fruition, what to expect from there. I think the idea is stacking those yields.
Stack those yields.
Stack them.
Go
EOS!
EOS!
Haven't done one of those in